at the same time, every time they go and print new shares, that reduces our ownership in that company that we like and we own for a reason.
Right. We're Compound Everything, and today we are talking money markets and
Market capitalization.
Market capitalization.
So why are we talking about market capitalization?
I think this was mainly brought on by a question we got asked on a forum that said, I think the original post had something to do with market capitalization, and then I made a comment that a cheap stock isn't a value stock.
Right.
And then the next comment was, explain this to me because I don't understand it.
Right. And so...
And then it kept going, and we realized there's a lot of people
who actually don't understand the concept.
Yeah.
And when we first started investing, I think that was probably a bit of a stumbling block for us too. It's quick to understand, but there's a lot of idiosyncrasies and a lot of concepts that you could understand better once you do understand the concept of market capitalization. So it's simple, but there's a lot of things that launch off of that.
Exactly.
So which we'll get through a little bit if you can stick with us through this video.
And I think the thing about market cap, or just anything that seems so simple to an investor when they've been doing it, is that it wasn't always a simple concept.
Right.
And you forget that when you talk to people. So when you make comments like cheap doesn't equal value, that doesn't make any sense to someone who's coming.
Right, who's coming at it.
Yeah.
Just looking at a stock price specifically and comparing two stock prices. So what is market capitalization?
Well, the way I look at market capitalization, this is not a definition, but this is how I like to look at it, is what would I pay, or what do I have to pay to own the entire company? Well, why don't we break down the mathematical, simple math. It's very easy to figure out market cap.
So the simple math of market capitalization is you take the total shares outstanding and then multiply it by the current asking price per share. But what it is, market capitalization is the price if you were to have enough money to buy the company in its entirety. So the example we thought of was Disney.
Yeah, and what the public markets are asking for it at that time.
Right, what the public markets are asking for it at that moment in time. So let's do Disney. Okay, so Disney has shares outstanding of 1.819 billion. And its share price as of today, which is July the 11th.
About $96.
Which is about, I think it's
$93.
$93. So if you take $93.65 and multiply it by 1.891 billion, you'll get a market capitalization of roughly $170 billion. Yeah, and that's the price to buy the entire business if you're able to.
Now, if I was able to, and I had $170 billion to spend, and I wanted to invest it in a great company, if I thought Disney was that company that would continue to grow and it was a good value, I could
purchase the whole darn thing.
If it was possible, purchase every share
of Disney.
Obviously, that's not how it would work, but
given the price. But that is how large scale investors do it. If you're a large investor, so we follow Warren Buffett, and he's done a lot of acquisitions that are of substantial size. He'll go in and offer to take over the company. Essentially what they're doing is buying up every single share.
And that's where you'll hear the term owner's earnings from. It's based on what will I pay for the whole business. The whole business, it's not a per share price. It's generally when Buffett's using owner's earnings, it's what is this whole business worth?
Yeah. So the reason that market capitalization is so important is in part for you and I think our investing's gotten much better since we started thinking of not businesses in terms of just per share price, but rather thinking as a whole. I mean, obviously we don't have enough money to buy large businesses like that in their whole, but to think about valuing them as a whole, I think makes a lot more sense than to try and break it down on a per share basis. At least that's how it's worked for us. Maybe you'll find that works differently for you, but for us it worked well.
Yeah, that was a big, and then, it works well because you don't have to worry about the share price, because if the market cap says this is a buy, then whatever that share price is, you just buy it at
So
that
for
share
instance,
price.
let's say today Disney's trading at a market capitalization of $170 billion, but based on your fundamental valuations, you believe that Disney's worth $230 billion, then you go buy shares.
Right.
Today.
Right.
Right? So it really equates to just easier. It's easier to grasp conceptually.
It's also easier to understand, like, I don't know who said this, but maybe it was Ashwat Damodaran, but he's like, it's easier to understand too their competitive advantage in a way, because I know that whoever said this, and we've said this a lot, like if I have $170 billion, which is the market cap of Disney, could I start a business like Disney and take them out?
Right.
And the answer, I think, would be no. I would need substantially more money in order to start a business like Disney than 170 billion.
Yeah.
Which means for an investor, they have some sort of moat then. So
right.
Then I have to go in.
They have a competitive advantage.
So market cap actually has really helped me, because I can think of a business differently than just saying, oh, the share price for one share of Disney is $96. Well, what the heck does that mean?
Right.
Who cares? Who cares if it's $96 or $10 or $9,000?
For sure.
Yeah, but if you can see what is this?
It's a big
company?
picture.
Yeah.
The other thing it helps too is we like to look at debt. We don't like to have companies that have a lot of debt. And so you try and figure out debt per share. Well, no one really does that. But if you look at it from a market someone might. So if a company has no debt, that makes it easy. But if, let's say, they have a market capitalization, we'll use an imaginary company, they're trading at $100 million, and they have $50 million worth of debt. Well, that seems to be a substantial debt load. I mean, depending on the industry and things like that. Whereas if they have maybe $10 million of debt, you might find that much more appealing. And
again, more tangible. Right. I'm going to buy this business, XYZ, for $100 million, but I get $50 million of debt with that.
Right.
Right. So I have to, that would be a bigger risk than if I'm like, I'm going to buy this company, XYZ. It's an amazing company, substantial growth. It's $100 million, zero debt.
Right.
I get zero debt with this company.
Exactly.
Okay. So it just makes you think more.
As an owner.
So let's just recap market capitalization.
For sure.
Okay. So market capitalization is the outstanding shares multiplied by the current market price.
Per share. Yeah.
Yeah. Which means that if I, as an investor, wanted to buy the entire company, I would have to purchase every single share. And that's on a given day what it would cost me.
Exactly.
To do. And we like market capitalization because it helps us to have a more tangible idea of what the value of the company is.
Yes.
What it's worth.
Yeah. Helps us to think like owners.
Right.
Bottom line. Taking that to a natural extension, you can see then that absolute share price does not necessarily equal value. It really depends on how many pieces the company's broken up into, right? And that's the shares outstanding. Right. So let's take two other companies. We'll take Berkshire Hathaway and we'll take Shopify.
Okay.
So I believe the number of shares outstanding for Berkshire Hathaway is roughly 1 to 1.5 million. I can't remember exactly. I think it's 1.5 million. Whereas Shopify has 1.26 billion shares outstanding. Right. Okay. So the price per share of a Berkshire A share is, as of today, $418,411. Okay. Whereas the price per share of Shopify is somewhere around $32. Does that mean that Shopify is cheaper than Berkshire?
And here's the thing. If you are a novice investor, you're watching this going, well, this is ridiculous. But a lot of people on a lot of stock forums that we participate in don't understand this.
The concept.
And they will say, like, I saw this company, it's only $5.
Yeah.
Right? It's super cheap. Meanwhile, maybe the particular company generates $1 million a year.
Yeah.
Right? But their market cap is $100 million.
Right.
Even though the share price is $5. So that's what we're trying to explain.
Explain conceptually.
Right.
So if you were to buy Berkshire Hathaway today at $418,000 and change, you're essentially paying $7.50 for every dollar of earnings that Berkshire makes. Yeah. Whereas if you buy Shopify at $32 and change, you're essentially paying, I think it's $225 for every dollar of earnings. That's right, because their price to earnings is roughly $225 for Shopify. Now, the difference there is going to be the growth between the two companies. Now, Berkshire, being a very large company, is probably not going to grow as fast as Shopify. So if you think Shopify is going to grow like crazy, then you could maybe justify paying 225 odd times earnings for Shopify. But that's
because when you look at just the number of $400,000, the absolute dollar amount, $400,000 versus $32, cheap would imply $32
is cheaper. Yes.
Right? But there's a lot that goes into
There's
that.
a lot that goes into it.
So,
and you as an investor have to figure out what is the company worth.
Which is why we like to use the word value.
Right.
Like I said, we're helping people who don't know.
Yeah. Is Berkshire Hathaway worth $418,000 or is it worth $600,000? Is Shopify or is it worth $100,000? Is Shopify worth $32 a share or is it worth $60 a share or is it worth $15 a share?
Right.
And that's where you as the investor have to figure that out for yourselves.
Right.
So value is relative, price is absolute.
Exactly.
Yeah. So that's something to look at, and that's where market capitalization will help you as well. That, just knowing that concept.
But using these two stocks as an example of why share price doesn't equal value is, let's look at their PEs.
Right.
So you have Berkshire, $400,000, PE of 7.5.
7.5 roughly.
You have Shopify, share price of $32 and PE of
229.
229.
Yes.
So PE 229, Shopify PE 7.5.
Yeah.
Berkshire. Now that right away tells us that Shopify may not be as cheap as it looks.
Right.
And Berkshire may not actually be as expensive as it looks.
That's why I say value is relative and price is absolute.
Right. Yeah. And even if I saw a PE of 229, I don't even think it would make it on my watch list.
No, probably
but
not.
Some people it would, because they're going to look into other metrics.
Growth,
but for me, that just goes like, this is not a value.
Right.
It's too hard.
Yeah.
Too hard. But if I see a PE,
there's a high bar to jump over for that company to meet that kind of earnings multiple.
I see a PE of 7.5. I think, okay, maybe worth looking into.
For sure.
Right. So it's always good not to just look at that absolute price, whatever it is of the day, because that price actually really means nothing.
Right.
It only means something until you know what the value of the company is as a whole, and then you got to figure out what the share price is that you would buy it. That's the only thing.
Right. That's where it comes down to share price.
Yeah.
So let's go on to talk about stock splits.
Yes.
So sometimes companies will split their stock.
Yep.
So for instance, we'll go back to our example of Shopify. We said Shopify as of today has 1.26 billion shares outstanding. Whereas if you had looked maybe a month ago, they had 126 million shares outstanding. So they went from 126 million to 1.26 billion. So it was a 10-for-1 stock split. So if you owned 100 shares of Shopify before the split, after the split, you'll own 1,000 shares.
And if you're the type of investor, you're new, you don't know, and you don't realize that market cap is the amount of shares times the price, you would wake up one morning
and look in your account and go,
whoa. See that Shopify had dropped from 400 whatever dollars or 300 whatever dollars down to 32.
Right.
Right? And you might think, oh wow, it's like on sale.
Right.
And this is,
or you think you've lost a ton of money.
Or if you own it, you're having a panic attack.
Yeah.
But that's again where market cap comes in, because if you were to look at the market cap that day, it stayed exactly
the market cap
it moved with whatever the share price
would barely change,
exactly.
Right? So it's not like Shopify all of a sudden dropped like 90%.
Right.
Yeah. So the point being is you would still own the same proportional amount of ownership of Shopify pre-split as post-split.
Exactly.
Okay. And the other thing that sometimes stocks will do is they'll do a reverse stock split. So they'll not as often, but a stock that's trading really cheaply might do a 10 for or a 1 for 10 split. So they'll reduce the share count by tenfold.
Yeah.
So it can go either way.
And the best way
and it's basically immaterial because you still own the same proportional ownership of the company.
Completely immaterial.
Yeah.
Yeah. Companies will do it sometimes to make their stock more affordable.
Yeah.
That is one reason why they do it. So Google is eventually, I think they're doing a 20-to-1. They're around 2,200 today. 22, 23. And so they're doing it so like more people can. That's sometimes the reason. I don't know why Google's
afford more shares.
Can afford more shares or whatever. There's different reasons. Some people do it. And this is my own thinking. Some people do it because a lot of times people don't understand market capitalization and they see a cheap stock and it goes back up. And I wouldn't be surprised if that was kind of the impetus behind Shopify doing a stock split.
Right. Because they've been getting creamed lately.
Yeah. I think the CFO or CEO even came up and said, like, you just got to trust us.
Yeah.
Please
fair enough.
But there are reasons why they would do a stock split.
Sure.
So if anyone's wondering, like, why on earth would you do that?
Yeah.
But
Berkshire Hathaway actually didn't do a stock split, but they branched off a separate class of shares for that exact reason, because 414,000 is out of the reach of the majority of people, and so they do have another class of shares. It's called Berkshire Class B, which trades at 270-ish a share as of right now. So let's think of companies kind of like a pizza. In a sense. So if you have a pizza and you cut it in half, and you take half, and I take half. So you take one piece of the pizza, I take one piece of the pizza, we both have half the pizza. But now let's cut it into 8, right? And you take 4 pieces, and I take 4 pieces. You still have half the pizza, and I still have half the pizza. It's just however many slices we cut it into. You could cut it into 100,000 pieces. I'll take 50,000. You'll take 50,000.
Does not matter.
We still have half of the pizza. It doesn't matter. It's proportional ownership. Right. So that's the important thing to understand about stock splits and whatnot. Always think of your share ownership as proportional. Okay, that helps. And the reason we say that, that's actually a good launching point to our next point, and that is that sometimes companies will not only stock split, but they'll dilute.
We hate dilution.
So, in a sense, we don't like dilution. We don't like to see our companies dilute us. For the reason that we now have less of a proportional ownership in the company. Okay. Now our ownership is small. It's fractional. It's maybe millions of shares or millions of a share. But at the same time, every time they go and print new shares, that reduces our ownership in that company that we like and we own for a reason.
And it's
we want to own more of it, not less of it.
And it's very much like printing money.
It's exactly like printing money. So in a sense, stock printing or issuing new shares is kind of like fiat currency in a sense. And I heard someone say that in a Berkshire Hathaway annual meeting. I was listening to an old one, I think. So someone commented that share printing is a lot like fiat currency, and he's exactly right. Because again, I own less shares proportionally. So for instance, there's a company that I was looking at, it's called Asensus Surgical. So back in 2012, they had 1 million shares outstanding. And as of, trailing 12 months or the most recent quarter, they had, I think, 235 million shares outstanding. So if you bought shares...
from 1 million to 235.
Right.
So they really diluted their shareholders.
They killed their shareholders, right? So if you had bought, let's say, 1 million, or let's say you bought, 1,000 shares in 2012, they've reduced your share count by like 1/235 or whatever. So
that's terrible.
It's your ownership becomes fractional. So the point being is they've diluted shareholders in order to keep operations going and things like that, and to pay executives, and those are the reasons that companies will sometimes do stuff like that. But it reduces your ownership in the company substantially. So we don't like to see that.
So you have to look at that. Like, have they been issuing shares every year? If they have, you really might want to look into it as to why. It's
okay sometimes for companies to issue shares to make acquisitions. They'll do that sometimes. Well-managed companies will do that sometimes. They'll issue shares if they think they want to make an acquisition. That makes sense, but it's up to you as the potential investor or as the investor to determine whether that made much sense for them to do. Because if they go and make an acquisition that's accretive and it's good for their business, it's going to make them more money, you would like to see something like that. But if it's one that's either just the directors are,
if they're
pillaging the company essentially, to pay themselves massive exorbitant salaries, then that's that's a company you probably don't want to be associated with.
When they're diluting to pay themselves.
They're robbing you.
They're robbing the shareholders.
They're robbing the shareholders.
But then the opposite of share dilution is
share buybacks.
Right, which we do like.
Which we
providing that the management buys it at
a reasonable price.
Okay. Those can also be abused.
Those can also be abused too. If they can go out and buy shares when they're overvalued and essentially they're going and burning your money. They might as well give it back to you. All sorts of shenanigans can happen.
In the right context, we love share buybacks.
So I'm going to use an example. Now, we've been watching this company for a little while, don't own any, but Lowe's companies. So Lowe's, everyone knows Lowe's, I think, hardware store. And so back in 2006, they had, I'm going to check my nose, they had 1.535 billion shares outstanding. In 2006. Okay. And as of the trailing 12 months, they have 682 million shares outstanding. So in essence, they've bought back 2.25 times the number of shares.
Wow.
Right? So your share ownership has gone up 2.25 times. So if you bought 100 shares back in 2006, your percentage ownership of that company's gone up 2.25 times.
And you did nothing.
And you did nothing.
And you did nothing, yeah.
Right? So think of it on a grand scale basis. So let's say you had the money initially to buy 10% of Lowe's, okay? By doing nothing, now you own 22.5% of Lowe's.
That's crazy.
By doing nothing else.
And that's one of the reasons why, I think it was actually at this year's Berkshire meeting, Buffett said they love share buybacks.
Yeah.
And one of the things he said to explain it to shareholders was, it's like as if you owned farmland, you know, and then every 5 years a new acre just appeared.
Right.
That
just tacked it on.
You have one more acre, and then 5 years after that you have another acre, and you're getting all this extra land just tacking onto your farmland.
And eventually you go from having 80 acres to 160 acres of arable land. And you didn't do anything.
Yeah.
Yeah. So share buybacks.
Share buybacks.
Often awesome.
Yeah. And so that's why it's so important too, and this is a little, I'll digress here, but that is why management's so important.
It is, yeah.
Because when you look into companies and you look at the market cap and you think, okay, this company is valued, it's great, it's on sale, I think it's, you know, it's got all the moats, everything, and you put your money into it, you've looked at the management, you can trust that they're not going to dilute you without good reason. And you can trust that they'll probably bring you more value to your shares, either by growing the company, by doing share buybacks, but they're going to use the equity in the company to grow it.
That you've given them as shareholders.
And bring the shareholders more value.
Yeah. That's bottom line.
So market cap is?
Market cap is shares outstanding multiplied by current share price.
Yep, and we use it because it's more tangible. It gives us a better idea of what is the value of this business as a whole.
Yep. We tend not to like share dilution.
Nope.
Unless it's done properly. You have to watch that. And we tend to like share buybacks as shareholders.
Yeah, and a share split.
And a share split really means not a whole heck of a lot of anything.
So to summarize, when someone says this stock is cheap, what they should be, what that should mean when they say, oh, I found a cheap stock is, I found a stock that is undervalued and worth my money because it has the potential to get back up to intrinsic value.
Right.
If I say, oh, this stock is cheap, what I should not mean is that the absolute dollar amount
is inexpensive.
Yeah.
I hope that helps. Remember to like and subscribe and leave us comments.
Yes.
And we're Compound Everything. We'll see you next time.
Yeah.